Good afternoon, everyone. I'm Stacy Scott, Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm also your host for today. We host our monthly Lunch and Learn at noon on the last Wednesday of every month, and we'd like to thank you for joining us today. We always appreciate those of you who spend your lunch break with us. Today, Graham is going to address the current economy and markets and share his thoughts on where we go from here. Then we'll open up the floor for an expanded question and answer session. And a number of you have emailed questions for Graham. And if any of you happen to think of any other questions, please type them into the Q&A section of the chat box, and then he can answer those for us as well. And also, just as a reminder, you'll see Graham's calendar pop up from time to time during our presentation. And if you'd like to schedule some time to talk with him, please click on that calendar when it pops up and select a time that works well for you. And now, with all that covered, I think I'll turn things over to Graham.
Yeah, thank you, Stacy. Pretty exciting times, right? But in a very consistent pattern. So, I wanted to kind of take today's call and kind of go back to really one of our original calls that we did, these Lunch and Learns. And that was kind of right after the shutdown from the pandemic in 2019, and really start to go over kind of where we've been, where are we at, and where do we think we're going to go from here with the markets, the economy, and maybe some thoughts and considerations on what you might want to do. Certainly on what we're already thinking about doing for you. But first off, thank you all for being on the call. I know the kids have gotten back to school, and now we're kind of getting back to some normality, hopefully. So let's think about pre-pandemic. So February 2020, I'm going to go all the way back, even I think it was really February 2020, all the way back to 2019. Equity markets were at all-time highs. Gross domestic product was roughly about 2.4%. And gross domestic product is the growth of the U.S. economy. We had the unemployment rate, not the employment rate, the unemployment rate at about 3.5%, and inflation was roughly around 2.1%. Really stubbornly low since we went into the recession, depression, if you might, of 2008-9. Now, even at that particular time, we were calling these markets as a kind of a perfect market, right? We were saying, hey, listen, don't be surprised if gross domestic product really slows even further. Maybe we go into a light recession, some volatility coming in the market, so on and so forth, right? Certainly didn't think we were having such a shutdown because of a pandemic. Then we look at today, all right? So all the way now, we're looking at markets at all-time highs again. We have gross domestic product about 6.5%, arguably going higher. We have the unemployment rate at about 5.5%. Now, keep this in mind. In the trough or the peak of the pandemic shutdown, we were down as much in the unemployment rate as about 14%. So we've really come back a lot, but we're still quite a bit higher than we were, kind of pre-pandemic, that February level. The inflation rates is roughly about 5.5%, 5.4%, roughly in that range. Could go up higher, but we do think as the economy is opening up, which it is, with some stutter steps here with the Delta variant, we see that the inflation probably moderating a bit, all right? And we'll get into that in a minute. But I think this is an interesting little stat that we pulled up. If we look at the pandemic low of the S&P, it's up 100%. And we're just talking about the S&P, Standard & Poor's Index, instead of the NASDAQ Dow, just because it's generally a much larger index, much more diversified. And it's up 100% from the trough lows. On average, it takes about 1,000 days from peak to trough, kind of areas of trough back up to peak. But we did it in about, 354 days? So a dramatic bounce back in the economy, right? So if we think about how many bull markets that we go in compared to bear markets. So we put up a little slide here talking about different periods of time. But if we look at it just over the last 50 years, It's basically 50-50, bull markets compared to bear markets, up markets compared to down markets, right? I think it's about 53% upside and about 47% on the bear side over the last 50 years. So you know what? It really doesn't necessarily pay to try to time this thing because you don't know. It's a 50-50 chance you're going to get it right, right? So where does that lead us at this particular point? Well, if we think about the positives right now, right? So the positives right now are record low interest rates. Think about this. Let's think about the 10-year treasury. All right. The 10-year treasury is a government backed note. All right. And a lot of mortgage rates and a lot of, things follow or track or just is the gauge on interest rates. And we're going to get into my conversation with you is about the Fed funds rate, their tapering and possibility of rising or raising interest rates. And, they can naturally, organically rise on their own. We're really at really low interest rates. I think today we see the 10-year treasury about 1.3%. The Fed funds rate lower. I mean, really low rates. It's spurring on, hopefully animal spirits to go out there and get loans or refinance or spend money. I mean, that's why they keep rates low and arguably artificially lower than they need to be with the improving economy. But all that being said, we got high productivity, right? We're learning to work with less and be more productive, right? Healthy consumer. If anyone's thinking that the consumer is not spending money, doesn't want to get out and travel, they're just absolutely incorrect. We just don't see those numbers. Either the consumer still has money hitting the bank accounts. We got the child's tax credit going out right now, $3,000 to $3,600 per child. That's going to be going out. That's money that's going to need to be spent. Where? Probably retail, back to school, all those areas, vacations, right? Now, again, we got a little stutter step with the Delta variant, but that has not changed that we still have a healthy consumer. As I mentioned, the government stimulus, the child's tax credit, we're in the midst of a possible 3.5% infrastructure bill being approved. I think we're waiting for the House to come together on that one. That's going to be more money that's hitting industrials, consumers, technology, different things like that, that it's going to be used for in many other areas. That's going to be there. And then corporate earnings, you can have, what I always like to say, you can have some really great companies, but terrible stock prices, or you can have great stock prices and terrible companies, right? But generally stocks follow earnings. As long as we have good earnings, and 85% of companies that have reported so far, we're pretty much well into the late 9 innings here, have beaten earnings. And they generally only beat 3 to 5%. Think about this. They're beating at 18%. That's a massive. Now, I want to also lay the groundwork. All this great stuff isn't going to continue at this great level, right? There's going to be a moderation. So here are some future challenges that we're going to have. I think overall expectations, are we going to have gross domestic product at 5 and change or 6 and change? Is the consumer going to be aggressive in their spending pattern in years ahead? Are interest rates going to be as low today as they're in the future? And the answer is just not. But it doesn't mean that things can't still roll on. But let's look at some of the challenges. So we still have the Delta variant out there. What is that going to do? Probably not a broad-based shutdown, but definitely some moderation, some fear, kind of this wall of worry that the consumer is climbing on that. Rising interest rates. And I do want to keep in mind, there is this whole camp here on rising interest rates. Yeah, rising rates are bad. That's simply not the case. I'm happy, click my calendar when it comes to cost, or we just have a conversation with myself or any one of my team members. We'll go over those stats. Rising rates is not necessarily bad for the stock and bond market. In the very short run, it might be a reaction, kind of a temper tantrum, if you might. That's a term that's thrown out there. But actually, it's showing and confirming that we do have good times. And at least the powers that be, maybe the Federal Reserve, is lowering the bond buying. Or they might be raising the Fed funds rate to acknowledge that, so we don't have an overheated economy. And right now, there's no doubt about it, we're overheating. So it's really the pace, how quick and how fast, that could be more of a detriment than just the slow, steady rise of rates. Now, there'll certainly be a pace or a point where rates get so high, the risk reward doesn't justify, but we're far from that right now. Inflation, wage inflation. Think about this. When inflation is going up, some of this is going to be transitory, right? I think we're about 5.4, 5.5% inflation rate. Some just going to pass through, because when things calm down and the reopening and all this, the animal spirits to travel and spend and get out and about is going to calm down over time. Some of that will be transitory. It goes through the system. But it doesn't mean we can't have other inflation, like wage inflation, that sticks with us, because it's really hard to say, hey, listen, we're going to give you an increase in your salary today because, inflation's up, and then we're going to take it back. Really don't see that usually happen that much. So that might really stick with us. And some of the others. So again, we're 5.4, 5.5 right now, may go up a little bit higher. But I do expect that to moderate a bit, but it doesn't mean we're going to drop back down to that 2.1. We might still be up around 3.5%. We'll just have to wait and see. I think what I've talked about on kind of the end of the week wrap-ups with the China crackdown, and that is out of our control. I mean, you have really good companies that the Chinese government, right or wrong, is cracking down on the companies, and causing dramatic drops in those share prices, 20%, 30%, 50%. And you just don't know, because they might have great fundamentals. But if that government or any government comes in and puts in regulations or penalties, so on and so forth, limits their growth or penalizes them for how they do their business, that stock price is going to come down to some degree. So that's something I think, it changes the psyche, if you might. It puts a doubt out there. And anytime you have doubt, you start to increase maybe some volatility or question marks. So a little bit, again, of wall of worry. Slowing demand. There will be a point where we just aren't hoarding everything. We're not hoarding getting out and getting about, like with vacations or cars or homes or something like that. There'll be a point, but how quick, how fast, we'll just have to see. Accelerating prices on home values and vehicles. Again, getting back to some normalcy, where you just, and I hear this all the time, I just think we're going to have a huge correction in home values. Well, I'm never going to say that anything is out of the woods, because there's no crystal ball here. But as long as you have a good consumer, reasonable inflation, pace of inflation, or interest rates rising, everything can work itself over time, but it still might lead to some volatility, or maybe the car values or the home values don't appreciate so much so fast. I think we had last quarter home values up, or last month up 18%, or this year up 18%. Absolutely huge. So what if they moderate back down to 6? Or what if we have a year or two where they just don't go up in value? Is that a major correction? I guess it depends on how you look at it. I don't think it is. And I think we're all a little blessed here in a unique environment to already get the appreciation that we've had in these values, unless you're going out trying to buy it, right? So then we think about equity valuations. I hear this all the time. The markets are so expensive. And they're right. They are absolutely expensive. They're expensive if earnings can't justify. And there will be a point, right? So hopefully it'll be a steady adjustment. But, I think we're arguably trading on average about 26 times forward earnings. Maybe the average is around 16 to 19, depending on how you look at it. So, yeah, there's no doubt that the valuations are high. But again, it doesn't mean that we're set up for a huge pullback. It doesn't mean we won't get it, though, of 5, 10, maybe more. And you always have to expect that, right? Then we think about the government deficit. We have to pay off and pay down all this money that the government did to prop up and to incentivize. And there'll be a day of reckoning. Now, it's not going to be flagged, that's waved, but it certainly will be something we have to address. What to expect? Maybe higher marginal tax rates, maybe credits that we get for taxes or deductions, maybe coming down. maybe Social Security, like when you receive full Social Security benefits might increase for later generation here. But these are all things that I think will happen over time, right? Again, it's not something that happens all at once. Maybe a couple things are, and it's not huge moves. It's a lot of little in how it affects the the U.S. Consumer as a whole, or the taxpayer as a whole. So again, click my calendar if you want some more information on that going forward. So let's think about what to expect. Lower inflation. I think some of it will be transitory. All that's there, the 5.4, 5.5, isn't going to be 100% there with us in the future. It's going to be a bit transitory. So we have to expect it to come down. But I'm not going to be the one that tells you, and again, I don't have a crystal ball. There is no crystal ball here, that it's going to come back down to as low as it was. I don't think that's really in the cards. I think we have to expect higher employment, not unemployment, employment, getting closer to that 3 range that we're at pre-pandemic. So I think we still have some room to come down, but maybe it doesn't get to 3. Maybe it's 4, 4.5. That's still really good employment rate. Increased volatility, you have to. I think as we start lowering the tapering, the Federal Reserve is going out and they're buying a lot of bonds right now, and they're keeping rates out. All right. So when bond prices are going up, the yield on those bonds are going down. Right. So on older bonds. So when they slow that purchase, bond prices are going to kind of edge up, and I'll illustrate that here in a little bit more. So I think you could have a little bit of bond volatility here. I think you're going to have some stock volatility if the market tries to weigh out how quick, how fast. But we'll have to see how much. But I do expect some. I think it's unrealistic to think you won't have some additional volatility. And then we got to justify earnings. There's going to be comparables year over year on these earnings and expected growth that aren't going to be as reasonable. And it's one thing to talk about it, or the analysts talk about it, or the companies talk about it. It's another thing when they report it, and now it's the fact, right? So again, expect some more volatility because it's been pretty straight up for a while. We just haven't seen a lot of real volatility. Muted market returns. I don't want to paint a picture that we're going to have a rolling 10-year average on the S&P, which we've had of just under 15%, roughly about 13.5%. The average return for the S&P since 1926 is roughly 10%. If we reverted to a 10% average return or 7% average return, or even lower, that might not be unrealistic as we try to digest over the next couple years, maybe not this year, but the next couple years, the slowing or the digestion of the comparables for these companies' earnings, right? So the companies might still do well, but they did so well in a very unique time, it's going to be hard for them to justify those earnings going forward. Doesn't mean there has to be a huge market correction, but it just means, what if we go with a year or two where, heck, I don't know, maybe we just don't have any positive returns in the market indices. We'll just have to see. Then it's going to be very specific to how you invest and where you invest, instead of just broadly investing and making positive returns, which is the environment that we're in right now. So if we look at what are the keys to success going forward, I think it's going to get down to good old-fashioned roll up your sleeves, and it's not just all about passive investing. It's going to be some more active investing, really kind of what we practice here with passive investing, and that is good old-fashioned diversification. You can't be all in one area. U.S. can't be everything, but we could still be the best house in a really challenged global neighborhood. But so maybe we consider international. Look at the valuations international compared to the domestic. Developed Europe or emerging markets who are still going through their own challenges and delays in reopening, Delta variant, their valuations are less than the United States, and up to a third or a half in some of the emerging markets. And they've really underperformed this last decade compared to the US. So there could be opportunities here, there. And, I get the other thing. It's like the struggle right now between growth and value. Companies that, are all about growing, not distributing income back to share value, shareholder. Maybe some sectors like financials or industrials and materials are considered more maybe value area. I think it's a good old diversified portfolio with a weighting into both, and just get back to quality, right? I think at the end of the day, if you look at what you would own in your portfolio, in a good diversified portfolio, in a pandemic or not, and you could say you would own that, then that sounds like a pretty reasonable portfolio. You need growth and value. You need defensive, and industrials. You need stuff that performs in a secular, ultra long-term market, positive, and then you need stuff that's cyclical. So you just need to evaluate where that plays a role in your portfolio. So then we think about dividends and interest. I'm a huge fan of getting paid to wait. I love to get paid to wait. So think about having stuff that has dividends, opportunity to increase dividends, but don't get greedy with your dividends, because companies can go in and cut those, as they're trying to preserve cash flow and maybe pay down some debt or whatnot. And then good old fashioned allocation. Right? I do think from an allocation from stocks to bonds, and from that context, stocks still look more favorable than bonds. Think about it this way. We're showing a seesaw. Two kids on the playground, you might have been on one, one's jumping harder, a little heavier than the other. So when interest rates go up, older bond values go down. Why? Because people who are buying newer bonds are having the opportunity to buy bonds with higher interest rates. So those principal values go down. So it's kind of like bonds are trying to swim upstream. And that can be a real challenge for the bond market. But equities traditionally are an inflation hedge as long as earnings are there. And again, I do think they're going to be a challenge. So I think it's a bit of a give and take and in the pace of those rising rates. But I still do feel good quality equities over bonds, and that's how we've been managing portfolios for years. I don't see any reason why that's really going to change at this particular point. But it doesn't mean they don't have a role in your portfolio. We just got to see how much and how you position those bonds, because actually our bonds have done well for clients, just not as well as equities. But that's okay. You just got to know why you're positioning those assets in the portfolio. Stacy, I've talked enough. Why don't we turn this over to a little Q&A?
Okay, yes, we actually had some questions sent in. And the first one is, should I be in all stocks or all bonds?
Well, I think you already know how I feel about that. No, you got to have that diversification, right? All bonds, you might lower some volatility. You might be guaranteeing yourself some volatility. You might be guaranteeing yourself loss. So we got to think about real returns here, right? So think about this. If inflation is 5.4%, right? And your bond that you own, say conservative, investment grade government bond, let's just give it credit and say it pays you 3%. Did you make anything? No. You lost 2.4% in that situation. And then if you're taxed on that investment, you lost more. So we got to think about real return here, risk reward, because everything has risk, right? So we gotta weigh that out. So I think a good diversified portfolio within stocks, within bonds, I think that's the much better approach.
Very good. Okay, our next question is, does the 60-40 model of stocks versus bonds still work?
I could get shot on this one. It's a challenged model. I'm not going to lie. When interest rates are rising, and again, you have to come up with your own comfort level of risk, reward, your time horizon. So it's not a simple statement to make. The biggest thing I would say, you're going to have potentially lower returns in a rising rate environment, having more bonds over stocks. Simple. As long as earnings are there. If earnings are really not there and we can't justify valuations and we don't have a moderation through this, it's more dramatic, more cut and dry in terms of stock volatility, you probably would like a more traditional model of 60-40. I tend to lean to a little bit less traditional model than 60-40, maybe a little 80-20, 70-30, maybe even less than that. That's how we've been modeling portfolios for years now. But again, it's case by case. We don't cookie cut anything. I think it has to be very custom to your goals and objectives.
Absolutely. Here's another question for you, Graham. Are we going to get a big correction in the market?
That's a crystal ball question.
I know. I was about to say you need to pull out your crystal ball for this one.
I do. Again, go back to the expect volatility, right? I'm not running for office here, so I can be a little more candid with y'all, but you have to expect volatility. We see rotation within the market, right? So I got in this a lot. Oh, this market's got to correct big. No, it doesn't have to do anything. The odds of it doing it are pretty good, but does it have to? And then how long would it stay down, right? So the amount of time that the market has gone through a digestion, if you might, 5, 10, and then a bear market 20%, to then peak to trough, right? We just looked at the S&P, and the pandemic averages 1,000 days. It only took 354 peak to trough, right? So, and circle back. So the amount of time and the efficiency of the market has changed. So I would not be expecting a protracted pullback if we get one. I think it would be one that's bought, but I think you have to expect 3, 5, 10%. That has to be something that you expect at any time. You might get even a 10, 20% pullback within the market, but not really a pullback on the indices, but pullback within sectors like growth compared to industrial, value compared to growth. So you could see that. But I think generally you have to expect some volatility, right?
Yes. Okay. Good answer. Okay. So another question is, are international markets attractive to invest in?
Not really over the last 10 years. I mean, you've outperformed in the United States, from a valuation, because they're trading at a lower value of some sort compared to the US based stocks doesn't mean their companies are any less quality. It might be just situations. It might be geopolitical situation like Chinese based stocks that are now affecting some potential fundamentals of these companies. But originally these companies were just fine. But if you do look at developed Europe, Latin America, all the way over to some more pure emerging markets, we are seeing a pretty big divergence compared to US valuations. So from a value fundamental standpoint, they look attractive. Yep.
Okay. And then I think we have time for one more question, Graham. With the housing and markets being where they are, should I invest?
Yeah, absolutely. But it's got to be what you're investing in, what your time horizon, what your goals and objectives. Here's an example. I've been getting this one obvious a lot lately, and maybe a lot of you out there have been thinking about it. Should I buy some real estate right now because the values are appreciated so much? Well, one, be very selective, right? And then think about your time horizon there. If you're going to buy it and flip it, that may be challenging right now. I don't know. But if you're going to stay there and it's going to be your long term, are you concerned if maybe it moderates 5 to 10% in value? Probably not, because you're not planning on leaving, right? So a lot of our retirees, they're thinking, listen, I think I want to sell here, and maybe I want to move to Hilton Head or some different areas. And you know what? When you're thinking about that next stage of life and you're not worried about, the short-term volatility, because you're thinking about your long-term goal or that next stage of life, then I think you're absolutely fine. Stocks, I think you certainly need to be a little, focused on quality, be a little sensitive to timing there. But I think it's all about the time in it, not always the timing, right? So I would really say if you're not in the market, you need to get some in and leg in. If you're already in and you got some really big profits on really lower quality stuff, even some really high quality stuff, and maybe you're a little out of proportion or out of your balance, I think it's reasonable to diversify or get slightly more conservative. And sometimes you can just get slightly more conservative in your investment mix, and that can be with stocks, bonds, or real estate, just upping the quality of your investments. So, there's always a time to invest, and it's always a good time to invest, long story short.
Okay, well, thank you so much, Graham. This has really been an informative and interesting session. And thank you to all our viewers for joining us and for getting those questions into us. It's been a great interactive session. We hope to see you again at next month's Lunch and Learn. And in the meantime, please remember to follow us on Facebook and check out our website to view up our weekly wrap-ups and any other valuable information that we post. Okay, thanks and have a great afternoon.
Thank y'all. Have a great day.